Asset management companies and those counters have had a good run for the last few months. The task of managing others' wealth at a time when equities are doing relatively better is, well, maybe a competitive job at the very least. But the fact remains that asset managers are looking far beyond just equities. And think of a team which has got not just the asset management business, but a whole host of other capital market related business in their foray, and talk about what could happen over the course of the next 12 to 24 to 36 odd months. We've got the team at Motilal Oswal with us, Navin Agarwal, the MD of Motilal Oswal Financial Services Limited, and Ashish, Somaiyaa, the MD and CEO of Motilal Oswal Asset Management, join us right now on the show. Thank you so much, both of you, for taking the time out and speaking to us on BloombergQuint. Navin, if I can start off with you, when we look at the capital markets business at large, save for, for almost all players, save for AMC and the yields and the uptick in equities under management, the other businesses have faced challenges. Can you give us the big picture of what the non-AMC equity-linked businesses are doing and can do over the course of the next 12 to 24 months?
Sure. So basically, as far as the capital market businesses are concerned, we have a large retail broking business which has a footprint pan-India of over 3,000 retail outlets, and we service about 1.25 million retail customers. Also, we have institutional equities business which has clients from Tokyo to San Francisco, all over the world, and all the Indian mutual funds, insurance companies, banks are the clients. And then we have the investment banking businesses. So these three businesses collectively form the capital market franchise of the firm. And the businesses have done quite well, actually. If you look at the last 4 years, and if I analyze the first half numbers, the revenues have actually grown at the compounded rate of 25%. They've multiplied 2.5x from about 500 crores in March, about 4 years ago, March 2016, to first half annualized number of almost 1,250 crores. And profits have actually trebled. They've grown at over 30% per annum, from 60 crore rupees in FY16 to the first half annualized number of 180 plus crores. So it's not been such a bad time after all, because buoyancy in equities also is good, for the capital market franchise. So much bigger mutual fund AUM is also good, for the markets. And bear in mind that this has happened in the backdrop of 2 or 3 things. First, the small and mid caps have not done very well, which is where retail participation is usually quite high. Second, we've also seen mutual fund flows in the last 12 to 15 months being quite lackluster. It is mostly SIP flows that we've seen coming through. If you look at the investment banking deals, the IPOs, that's been very lackluster also. And then above all, if you overlay what is the state of the corporate sector in India, we are at a 2.5% corporate profit to GDP, right? Which is way below what the highs that we've seen a decade back. So the capital market business growth of 25% compounded top line for the last 4 years and bottom line of 30% plus over the last 4 years is despite all of these headwinds. So why is this happening? Why is the profit and the revenue continuing to grow? So number of clients have grown. We used to have about 500,000 clients 4 years back. We continue to acquire new clients. The client base is now 1.2 million. Also, the cross-sell of financial products to these clients used to be very minuscule. Our total AUM in the retail broking business alone used to be 2,000 crores. That is now at 10,000 crores and continuing to grow quite strongly. So there are many, I would say, internal initiatives or bottom-up levers which have helped us drive both the top line as well as the margins, profitable EBITDA margins of this business, such that the bottom line growth is over 30%.
And there's some positives as well. By the way, we just did the story this morning and we were talking about what wealth managers have done. We'll come to Ashish about that. I think the new fund that you've launched on the wealth management side, some stunning returns. So there are some positives to talk about. But Navin, the question is, on this non-AMC business, and we'll talk about the AMC business first in detail. In the non-AMC business, the last 4 or 5 odd quarters, if we see, broking revenues, not just for you, but since we're talking about Motilal Oswal, I'm referring to you, the yields, etc., have all either stayed stagnant or gone down a bit. We see costs, because of the hyper-competitive intensity, moving at a probably faster clip than what revenues are. 4 years may have also been a factor of lower base. From the base that you are at, and you are very large, how would the next 2-3 years look like? Are you confident of these numbers improving, or is it difficult to project that right now?
I don't think it's very difficult to project that, because you always have a funnel and you have an active client ratio. So our active client ratio right now is at 20%, and there's headroom to take that up. So out of this 1.25 million clients, the ones who are really active are 250,000. The other 1 million clients are not active. And also our distribution expansion, our franchisee onboarding continues. So we have a funnel, and that funnel shows us that this first half we've added something, this December quarter we are going to add something, March quarter we're going to add something. So it's very clear. In fact, the employee base in the retail business has actually been taken up to drive this acquisition initiative. But I must highlight to you something interesting that is happening. When you look at the surface, you see that there's hyper competition, there's zero broking trends globally, Charles Schwab, E-Trade, etc. And in India, where more and more traditional brokers are also converting into a zero brokerage platform. Now, I want to just give you a little context. We all know smoking is injurious to health, trading is injurious to wealth. And when that trading is made very easy, because you have it on your mobile app and you can do it on the fly, and when the cost of trading is zero, right, that time to zero for a retail investor is actually accelerated rather than decelerated. So what do players like us do? They provide the speed breakers, right? So we provide discipline to these clients. We provide advice to these clients. And then we provide cross-sell of high-quality products which at least stay intact or continue to grow. So some of our products that we've cross-sold to these clients are at a lifetime high in terms of their NAV. Right? Focus 35 NAV is near lifetime high. So on the other hand, their own personal portfolios or trading portfolios are down dramatically.
Sure.
So this provides them, a little ease of life. If you go back in time, earlier, the only time when retail broking franchise and retail broking revenues and retail broking profits expanded was when there was a raging bull market and small and mid caps were doing very well. That was one structural, one cyclical factor. Now you've got one more factor added to that, which is the onboarding of a lot more first-time investors by these zero brokerage platforms, who will eventually need advice, who will eventually need discipline, who will eventually need hand-holding. And that's how we are positioned. So we are pure play, non-discount, full-service, value-added brokerage.
Okay. Let's talk about something that's actually got a lot of fanfare now, Ashish, and that's just two stocks in the listed space, though, the AMC business.
Yeah.
But the kind of interest that's suddenly garnering, and the kind of commentary with regards to the future, the growth, because of various factors, be it under-penetration, be it the fact that there is a natural growth in AUM over a period of years, all of these factors, put it into perspective for us. And as a business, AMC, just all of them, how do you see the progression happening? And is this a value proposition for investors?
In fact, yesterday I came across some data which really got me excited, because I think I heard some release from the World Gold Council which said that for the first time Indians are actually liquidating gold to some extent. And I mean, that's just part of it. But I think that there are multiple tailwinds for asset management holistically, right? Two or three things. One is that factually, whether it's equity broking or whether it is asset management as a space, we have the benefit of huge number of new clients coming in consistently every day, every month, every year. All the digital trends, they are only accelerating the onboarding of clients, because I don't know if everybody realizes this, that mutual funds, and I'm not saying in general equities, specifically I'm talking mutual funds, is the only product which is 100% paperless, meaning that you read about me somewhere, you can download my app and buy it, and in the next 30 seconds you will be my customer. So I think digital is a humongous trend for asset management. Savings habits anyway, which we are aware of. And I think in some ways even investment management is going through mutual funds, because till recently the number of equity investors, number of bond investors, FD holders, all of that is a natural market for them to get into professional management. And the last thing to keep in mind is that it's a scale business, right? I mean, how much investment you need to manage, say, three times the AUM. I think the discussions are all around the capacity and the performance you can generate, but they are never around the constraints in terms of how much investment you will need and how much manpower you need to put on the table. So I think that it's from all economic perspectives, it's in the kind of right place.
So if I were to ask you as an industry person, where do you see how much, or rather what's the rate of growth that you see for the AMC business, the industry?
Industry. See, I would put it this way. There are, sometimes it gets into the throes of a virtuous cycle. So what happens is that if the market does 10 to 12%, our assets can appreciate 12 to 15%. And rightly or wrongly, the way the industry works is that if our assets appreciate 12 to 15%, then another 15-20% inflow also kind of tends to come in. So when there is a virtuous cycle, we can grow 25 to 30% year on year as an industry.
Top line.
On the top line, the
cost
AUM
will be much lower.
And the
Much
cost
lower,
won't.
sure. The uplift comes into play.
Yeah, right. And the third thing that you should keep in mind is that even when we have had, let's say, absence of a virtuous cycle, say last year, we are a bellwether because we are 100% equity. So you can get a sense of what is happening, and we are flatlining. It's not like, when the market didn't do anything, it's not like our AUM dropped 20-30% or something.
The argument, Ashish, that, and Navin, both of you can weigh in, the people are making is that in this surge of flows that are happening or are being witnessed, the top 2 or 3 or top 5 are taking away the lion's share of the business. The others, even in the top 15, are not quite getting there. You are in the, arguably, in terms of the reputation right up there, in terms of size, not quite in the top 5. Will that be a hindrance? Because if I look at the numbers in Q2 as well, unless I'm very wrong, your SIP flows have also come down. How do you plan to arrest all of that?
And if you're talking about penetration, then does that bulk of the new business coming in, does it still go to the larger ones, or?
Yeah. So a couple of clarifications on the AUM, and then I'll hand over to Navin. If you see the AUM, I think at our end, it's a conscious strategy that we have focused a lot on alternates. So what happens is that the numbers which get reported are the mutual fund AUM, right? And we are, as much as in the mutual fund, we have PMS and AIF. So as we speak, we are say just short of about 40,000 crores, and it's split right down the center. It's half and half. So the point is that we don't wake up every morning thinking how much has the industry grown, who's up there on the league tables and those kind of things. So we are looking at our segments and our offerings and how we can grow that.
No, but the question would be, sorry, and coming in just from an earnings perspective, because people would want to know, and the Motilal Oswal, the stock was so active last week, people would want to know what it does to earnings. So, I mean, the factor of earnings, Navin, will come in, or Ashish, whoever wants to dwell in, only when this downtick in SIPs get arrested. You may have qualitative reasons behind them, but it should show in the numbers in terms of the uptick in AUM, uptick in broking revenues, uptick in yields. When do we start seeing signs of that?
So, that few things. The profit of any AMC is also a function of the AUM. The AUM is not just a function of inflows, but also how the underlying stocks are performing.
Sure.
And if you see the YTD performances of all of the schemes, it's chart busters. Some of them are up 15-20%, which is quite a big number, and that straight away flows to your top line and then to your bottom line. That's point number 1. Point number 2, as Ashish rightly pointed, so the monthly inflows in SIPs are 7,000-8,000 crores, which annualized roughly for the industry is, let's say, 1 lakh or crores, and that lakh crore is itself a growth of 10%. So if you say a 15% appreciation per annum, 12 to 15% appreciation per annum, and a 10% SIP-led growth with zero discretionary flows, you're talking about a 25% growth, right? And if you have markets at new highs, then that number could be higher. And cost in this business does not grow, right, at the same pace. It's a very, very lean, limited cost structure, and that's why the free cash flows of this business is very, very high, almost 100%. All the profits are free cash flows, and the profit growth usually will be way higher than the top line growth. For instance, our own costs, which used to be 40 basis points to AUM, became 30 basis points to AUM, and now at 20 basis points to AUM. So as the AUM keeps rising, the costs keep falling, and all of that gets added to eventually the bottom line.
Still answer, I think I missed answering you on when you mentioned how do we arrest, the SIP growth and the inflows and those kind of things. So, look, we don't draw great solace from the fact of where we have reached in, say, 4 or 5 years, but we are a relatively young business as far as mutual funds is concerned, because our flagship was launched in 2014. The first open-ended fund came in 2013, Multicap 35 came in 2014, which is a large product for us. And this is the year when we've just about finished 5 years, right? So a lot of distribution onboarding happens after you have 3-year, 5-year track record, which is of demonstrable, credibility. That is first point. Second is that we were always an alternate house, and then we came into mutual funds. So it takes time for the mutual fund to penetrate and grow distribution. Third thing is that as we speak now, we are moving from about 26 locations to about 50 locations in the next 6 months or so. Because we've kind of grown distribution in lockstep with presence of our distributors, who's willing to offer us. So we track that. So by the end of this year, we are looking to be more like, say, 50 locations. Yeah. And there is a significant amount of uptick in terms of the number of sales and distribution people which are there. And the third thing, obviously, is that we have very, very effective digital strategy. So I can tell you one thing for sure, that if you take our market share in the total business versus you take our market share in direct or digital businesses, you will find that there is a huge difference. Normally somebody would think that we are a 30-40-year-old brand, but our acceptance in the digital DIY new generation investor is actually relatively higher.
Okay.
Just one last question, and any of you can take it from Motilal Oswal as a house standpoint. The focus now for the next 2, 3, 5 years is towards which business, which could be the next leap for you, which could be that big push that comes in for you.
So clearly, the change in the complexion of the company is towards asset and wealth businesses. So if you see our public markets asset management AUM is now $6 billion. Our private markets AUM is now about $1 billion. Our wealth management AUM is about $4 billion. And all of these earn us an annual yield. And all of these are growing by natural appreciation as well as inflows that we get. So last year was the first year when the firm profits from asset and wealth businesses became the majority of the profits of the overall company. And I think that trend is likely to continue because our market share in mutual fund business is still very low. We are at just about 2%. And
so headroom is there.
And the headroom is enormous. And as Ashish explained to you, we are doubling our distribution reach, number of cities, sales force. And all of these should, contribute to the growth of the businesses also.
Okay, one quick last question if you can. So if you can leave us with some estimates of how would the overall numbers look like, not getting into specifics out here, Navin or Ashish, but just a ballpark estimate of the console revenues, because there is MOH as well, which we haven't discussed, but slightly short on time. How does the overall pie expand over the course of the next 2 years from where you are right now?
So as I mentioned to you, the asset and wealth businesses continue to grow.
And that will be a focus.
That is a focus area for us. And aside of that, the capital market businesses, if you have small and mid caps really coming back, then those could have step jumps all the time. So we see, our return on equity, FY18 was 29%. And then we had write-offs in the last year on account of home finance business. But in the first half, we've already reported a 17% return on equity. So I would say that is the, for us, a 20% ROE is necessary, and that should be the growth in the net worth and the profits of the business anyways, in our view.
Okay, great chatting with you to get a synopsis of what the listed business could look like. Thank you so much, Ashish, as well as Navin, for joining me today and giving us your perspectives.
Thank you.